Don't be like Charlie. Charlie is that do-it-yourselfer who does himself in. Do-it-yourself is good for tile and grout. It is not good for asset protection. Charlie thought he'd save a few dollars forming his LLC online. With no guidance, he did it wrong. When he sold the property, he lost thousands and thousands of dollars. He did himself in by trying to do it himself. Don't burn yourself. Use Corporate Direct to set up and maintain your LLCs and corporations. Corporate Direct is owned and operated by attorney and rich dad advisor Garrett Sutton. Garrett wrote the bestsellers Loopholes of Real Estate and Start Your Own Corporation. He is Robert Kiyosaki's attorney for asset protection. He and his team will do it right. Visit them at corporatedirect.com or call 800-600-1760. Mention Rich Dad and receive $100 off your formation fee. That's corporatedirect.com. corporatedirect.com.
In a world of twisted facts, alternative narratives, corrupted corporations, and hacked feeds, how can we decipher the difference between truth and fiction? It's time to take back the truth. Read Robert Kiyosaki's Fake and learn the signs to recognize fake money, fake teachers, and fake assets. Determine what's real in a world where falsehoods are a weapon. Don't let fake advice destroy your financial future. Visit TheRealKiyosaki.com to read Fake by Robert Kiyosaki. That's TheRealKiyosaki.com.
This is the Rich Dad Radio Show. The good news and bad news about money. Here's Robert Kiyosaki.
Hello. This is Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. And today we have a fantastic show for you, a fantastic time. Everybody's excited. Markets are up and all this. So our very special guest today is Mohammed El-Arian. He is one of I think one of the most brilliant people in the world today. And whenever I see him or have a chance to listen to him, I stop and listen because there's a lot of lack of depth, should I say, and a lot of financial information. So when Mohammed El-Arian speaks, I listen. And Mohammed, he is the Chief Economic Advisor at Alliance and former CEO and co-chief investment officer at PIMCO, and which is a huge bond company. And he's the author of The Only Game in Town, Central Banks' Instability and Avoiding the Next Collapse. Came out in 2016. When Markets Collide, Investment Strategies for the Age of Global Economic Change. So the reason I want him on the program today is because the last time we had him on, which was 2016, he was warning of some dire consequences if changes weren't made. And I want to know what this brilliant man has to see for the future. But this is my question today. Well, I want to get back to the real basics. Any comments before we start, Kim?
Well, Mohammed El-Arian is one of the smartest guys I know when it comes to the whole economic markets and what's happening. And when I watch him, when I watch a clip of Mohammed, I have to rewind it. Well, what did he say? What did he say? What did he say? And then it comes through. So my job will be to keep it very simple so everybody can understand, because this is truly, he's had an immense wealth of information, and it's a very important show.
And we've had some fantastic people on this program, like even Donald Trump, but Mohammed is far smarter than he is.
We'll talk about Donald. We'll talk about Donald.
Because he's affecting the world economy right now, like it or not. So before we get in, welcome to the program, Mohammed.
Welcome, Mohammed.
Thanks so much for having me on. It's a huge honor for me.
Oh, it's our honor.
So before we get into your forecasts and how you can see clearer now, I was talking to my friends, and we're real estate people. There's mom and pop, they know about the stock market. They all invest in the 401k and IRA and then the stocks. But very few people know about the bond market. Man, I don't know anything about it. When I was talking to my friend Kenny, our partner in real estate deals, we've done hundreds of millions in deals in real estate. But I said, how do you invest in a bond? And we go, I don't know. So why would you invest in a bond? I went, I don't know. So then, because Mohammed's on the show, if we could step back and just keep it down to mom and pop basics, could you explain the difference why somebody would invest in the stock market versus the bond market? So let's say at $100, I put $100 in the stock market, or I put $100 in the bond market. What's the difference, Mohammed?
So if you put $100 in the stock market or if you put $100 in real estate, you have the hope that that $100 will be worth a lot more down the line. You can have what's called a capital appreciation. If you invest $100 in government bonds, for example, the safest of everything, you'll still get back $100. Okay, so you do not have the upside that a stock market has or the upside that a real estate market has. So why do people do it? For two reasons. One, most of the time, the bonds are safer than the stocks or real estate. So you're less likely to lose money than you would be in stocks and in real estate. Second, bonds offer you a stream of income. They offer you regular interest payments. So you can plan on having these regular interest payments. The trade-off is very simple, which is you give up the upside in order to try and protect your downside and get the stream of income. Now, there are many, many different flavors to the bond market. There are places where you can take a lot of risk. They're called junk bonds. They pay you a lot more. And, of course, the risk of losing your capital increases.
So junk bonds, where do junk bonds come from?
They came from companies. So companies think of how are we going to finance ourselves. And if you simplify it a lot, there are three ways of financing yourself. One is how much cash you generate, putting money back into the business. That's fun, but there's a limit. If you want to go on a major investment drive, for example, you want to borrow from the future. You're not generating enough income today, so you need to find a way to borrow the income from the future. You can do that one of two ways. You can issue stock, where shareholders give you money today in order to participate in the profits of tomorrow, or you can you can issue bonds. And bonds basically mean that you put out a piece of paper where you promise to pay back in 5 years, in 10 years, and in the meantime, you're going to make some interest payments.
Okay.
So the reason why companies raise money is because by issuing bonds, they don't give up on their ownership.
Right.
They simply, but it's a legally binding commitment. So it's senior, quote unquote, meaning that if something goes wrong on the bond side, the bondholders can take you into bankruptcy, which is not something that stockholders can do very easily.
So a stock market is an ownership where a bond market is just a loan, it's debt to the company, credit.
Yeah, in one case you're a resident, you own part of the business. In the other place you really are a tourist. You've lent some money for a while, but you intend to exit when that bond matures.
Okay, so thank you. Isn't the bond market much bigger than the stock market?
It is, and the reason why is because of all the debt that governments have. So governments fund themselves mainly through the bond market. And as we know, governments have ran and continue to run large deficits. So they spend more than they earn. They need to somehow cover that, and they issue bonds. And the reason why people buy those bonds, even though debt is at historically high levels, is because especially the U.S. government is considered, quote, risk-free, in the sense that it is unlikely to default. It has a printing press, to put it very mildly, so it can just print dollars if things get really, really bad. So the government bond market is viewed as the safest way to generate a little bit of incremental income.
So there's government bond and there's corporate bonds. Is that correct?
Correct. So think of the hierarchy. And remember, there's a trade-off between risk and return. The more return you want to be promised, quote unquote, the more risk you'll take. So government bonds, the U.S. Treasuries, are at the top of the safety element, but you get paid the least. So today, if you lend your money for 10 years to the U.S. government, you'll get paid about 3% a year. That's not a lot when you think that inflation is around 2%. So you're not getting paid much, but you have a, quote, safe asset. If you want to take a little bit more risk, you go to government agencies or you go to what's called investment grade, the really good companies. You want to take even more risk than that, you go to the high-yield companies, the iffy companies. You want to take even more risk than that, you go to emerging countries where things get a lot more volatile, but you get paid a lot more. So there is a whole range of risk return that an investor can look at. And the key issue is just to understand that whenever you promise more yield, more interest payments, is because you're taking more risk.
So thank you for that. I got one more question. Okay, so doesn't a bond have a price? Like, let's say the 10-year is coming out at 5%, but then they drop the yield down to 4%. Does the 5% bond get more valuable, plus time and all that?
Yes, and that's a critical issue that often confuses people. And that is that the yield and the price move in an inverse way. When one goes up, the other one goes down.
So there's people who make money just like a real estate flipper buys a property and then flips it or does this or sells it.
So suppose that you felt that interest rates were going to go up in a really big way. You wouldn't want to invest in a bond today. Why lock up your money at 3% when down the road you can lock it up at 5 or 6%?
So a 3%,
it doesn't make sense.
So a 3% bond in that instance would lose value.
Yes.
Correct. So in that instant, okay, you would wait because you could pick up the 3% bond issued today at a lower price in the future. Okay, because it is competing with other bonds that are issued at that stage at higher interest rates. So the reason why the price of a bond goes up or down is because at any instant in time, you are competing with people who are issuing new bonds at that stage. Think of a used car. Would you ever pay more for a used car than a new car? Only if it has something very special about it. If it has a very high yield, for example, you'd pay more. So the comparison that goes on in bond trading is what is that bond worth issued yesterday compared to the bond issued today. And since governments issue bonds on a regular basis, that results in quite a few price movements in the bond market.
So a final question on this, because being a real estate guy, I'm having a hard time hanging on to this one.
This makes perfect sense. Makes perfect sense.
So when QE, quantitative easing, kicked in and all this, and they were dropping the interest rates on bonds. So let's say I had a bond at 5%, and then they issued another one at 3%. Was that... So when interest rates were going down, was that why they said there's a bull market in the bond market or something?
Correct. And you wanted to go hug the Federal Reserve because when they start buying, they have a huge printing press in the basement. It's exactly like real estate. When you invest in real estate, a question you should ask yourself is, when it comes time for me to sell, who's going to be the buyer?
Right.
Right? And unless you intend to hold a piece of property through various generations, you want to be comforted that there will be someone who will be interested in your real estate down the road. Now, if suddenly that person happens to be the Federal Reserve with a printing press in the basement, what you have becomes worth a hell of a lot more, because they are what's called non-commercial buyers. They're buying not because they are pursuing some other objectives. So we had this wonderful situation that lasted quite a few years, whereby the Federal Reserve would be putting money into the marketplace, and in the process it built up a balance sheet of $4.5 trillion, and that raised all prices. So it didn't matter whether you were in a safe bond, in a risky bond. It didn't matter whether you were in real estate or in stocks. Because you had someone buying assets at such a magnitude, they pushed the value of everything up. So we had a bull market in virtually everything.
So that's what happened was that the Fed would write a check and buy a bond from the U.S. Treasury.
No, they would write a check and buy a bond from the marketplace.
Marketplace.
Okay. The marketplace, yeah. So, and I'll explain in a minute why they did that. But the minute, so I'm a bondholder, and suddenly the Federal Reserve comes and wants to buy my bond. It appreciates in price. It gives me money. Now, suddenly I have more money, so I go out and buy something a little bit more risky. And somebody else who gets my money buys a little bit more risky stuff. And then next thing you know, all asset prices are impacted, a little bit like a waterfall. Now, you have to understand why the Fed did this. The Fed didn't do this because they want to make us feel better because we own stocks and bonds. It started this in 2010 when our political process was polarized in a way when nothing was getting done. In fact, if you remember, we shut down the government. It was a real messy thing. Yep. And the Fed looked around and said, I need to build a bridge. I need to build a bridge to a better tomorrow. I need to find a way to get people to spend money. I need to find a way to get businesses to invest. The only thing they could do, they're not allowed to build infrastructure. They're not allowed to spend money, give tax rebates. The only thing they could do is use the financial markets. And what they did is very simple. By putting their money to work, they made us all feel better off. We would open our 401ks, our investment accounts, and find ourselves richer, having made money. And the hope was because we feel richer, because asset prices have gone up, we would go and spend
more money.
Spend more money. It's called the wealth effect. You feel better off and you go spend money. The more money we spend, the more companies start seeing the demand for their goods and services go up. And they say, wow, I better invest in the future. So they start investing more. So the hope was by boosting asset prices, they would also boost consumption and investment. And it worked a little bit, but much less. They were very successful in boosting asset prices. They were a lot less successful in maintaining very high growth.
And why is that?
Because first, the rich don't tend to spend as much of their money as other people. So if you make a rich person richer, they're not going to spend that much more. Okay, and who owns assets is the rich. Secondly, importantly, businesses realized that this was not genuine demand, that this was basically manipulated demand. So businesses held back on the investment side. Thirdly, I think a lot of people were traumatized from the experience of the global financial crisis. So rather than spend the extra money, they decided to save it.
Yes.
So it was basically fake money coming into the system.
Yeah, fake is wrong. It was basically meant to be a bridge. And I think that if you ask the central bankers at the time, they thought they would be in this business for maybe 1 to 2 years. Okay, they were literally building a bridge to another destination. They weren't providing the destination. They were just providing the journey, making the journey better. What they never realized is that our political polarization would last for such a long time that they'd still be doing that, not for 1 or 2 years. In the case of the U.S., they ended up doing it for 6 years, and in the case of Europe and Japan, they're still doing it today.
And some of the countries went down to negative interest rates, right? Just to
in Europe. I mean, think of the absurdity of that, which is that I come to you and say, please lend me money, and pay me for the privilege of lending me money.
So I put money.
Make sense.
I put money in I buy a bond, and it costs me money.
Correct. You buy a bond, and every year you pay me for the privilege of having bought a bond.
Okay, so Mohammed, we're going to take a break, but when we come back, we're going to find out what Mohammed thinks about the future, what's going to happen, because I believe that's why you wrote your book, The Only Game in Town, Central Banks' Instability and Avoiding the Next Collapse, because I suspect printing all that money has a side effect, and I think that's what you're concerned about. So we come back, we'll be talking to Mohammed about what he sees on the horizon now, plus all these trade wars with our presidente.
You're listening to The Rich Dad Radio Show with Robert Kiyosaki.
Don't be like Charlie. Charlie is that do-it-yourselfer who does himself in. Do-it-yourself is good for tile and grout. It is not good for asset protection. Charlie thought he'd save a few dollars forming his LLC online. With no guidance, he did it wrong. When he sold the property, he lost thousands and thousands of dollars. He did himself in by trying to do it himself. Don't burn yourself. Use Corporate Direct to set up and maintain your LLCs and corporations. Corporate Direct is owned and operated by attorney and rich dad advisor Garrett Sutton. Garrett wrote the bestsellers Loopholes of Real Estate and Start Your Own Corporation. He is Robert Kiyosaki's attorney for asset protection. He and his team will do it right. Visit them at corporatedirect.com or call 800-600-1760. Mention Rich Dad and receive $100 off your formation fee. That's corporatedirect.com. corporatedirect.com.
Your financial education continues. Now back to Robert Kiyosaki and the Rich Dad Radio Show.
Welcome back, Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. Once again, you can listen to the Rich Dad Radio Show anytime, anywhere on iTunes or Android. And all of our programs are archived at richdad.com. And we archive it because repetition is how we learn. And today's program especially, I would recommend you listen to it again. Get together with your friends, family, and business associates. Listen to it 2 or 3 times and discuss it. Our guest today is Mr. Mohammed El-Arian, the Chief Economic Advisor at Allianz and former CEO and co-Chief Investment Officer of PIMCO, this massive, massive bond company. And he's the author of The Only Game in Town, Central Banks' Instability, and Avoiding the Next Collapse. Very important word there, collapse. Any comments, Kim?
Well, I'd like to just get started because there's so much to cover here. So, Mohammed, you wrote The Only Game in Town, Central Banks' Instability and Avoiding the Next Collapse in 2016. What do you see since?
So the message of that book was very simple. And it was we're living in a very artificial time. That we've come out of the Great Recession and the global financial crisis that we all remember was so painful for so many. So we're out of the intensive care unit, we're out of the hospital, but we are still structurally impaired, that we haven't fixed a lot of what's wrong, and therefore we cannot run. The best we can do is walk, and the challenge that we all have is to try and fix what needs to be fixed so that we can sprint. Otherwise, we're going to stumble. So it was this notion of be careful. We've been living in a very artificial time, this new normal where economic growth is low. The benefits of that growth are going to just a very small segment of the population. Political anger is building up. On the finance side, things have been distorted in a nice way, but distorted by what we talked about in terms of Federal Reserve. Institutions are under pressure. People don't trust expert opinion anymore. It was to give the notion that we were living in a phase that was going to end and that there was nothing predestined about what's coming after that, and that we have to just realize the important thing is not just what you're going to be doing, but how you're going to be doing it.
So let me ask you this, Mohammed. Do you still use the word collapse? Because that's a very, very big, there's booms, busts, crashes, and collapses. And collapses I'm sure you chose that word carefully.
I did, and we've seen collapses. So this notion of be careful, you can go one or the other way, applies not just to the U.S., to around the world. If you're sitting in Venezuela, you're living through a collapse. If you're sitting through Argentina and your currency has halved in value this year alone, you're sitting through a collapse. If you're sitting in Turkey, you're sitting through a collapse. So we've had financial collapses around the world. And the warning was be careful, because at a certain point, if you don't pivot to a much better world, then the gravity of people being angry, the gravity of growth the ability to grow having been eroded, that becomes too big on you.
So let me ask you this, okay? Let's say I promoted you to God, General Overall Director of the Universe. How would you fix the structural problems?
So that's the interesting thing, which is there's a lot we can do if we just have political will. It doesn't mean there aren't uncertainty. There are major uncertainties out there. No one's quite sure how technology is going to impact what we do, how we do it. No one's quite sure about how many people are going to be displaced. There's lots of uncertainties there. No one's quite sure as to what China's rise means for the global economy. There's lots of things, so I don't want to make it sound as if there is an uncertainty. There is not just uncertainty, but the phrase unusual uncertainty. But we also know that we need to do things regardless. We need to invest in infrastructure. We have deteriorating infrastructure. We need to modernize the infrastructure. We can do that. We need to invest in people. Our education system has failed us repeatedly. There are many new techniques to improve the way people acquire skills. So we need to do a better thing in terms of our educational system. We have distortions in various taxation, regulation that reflected vested interests that we can fix. So there's a whole host of things that you can do that has the advantage of not just increasing current prosperity, but also increasing the potential for future prosperity. And that's before you even talk about the uncertainties.
So you say we're going to collapse.
So,
I mean, the chance, we're so adversarial right now. I mean, we're never going to get together.
Yeah, but we've done a few things. So the U.S. today is outpacing the rest of the world. So as much as we may feel that things economically are not great, they're a lot better than Europe, Japan, and the emerging world. We're going through a period where we've created lots and lots of jobs. We've been the job engine of the world. And that's been going on for a number of years. Wages are finally starting to go up. Businesses feel better about the future. They're starting to invest more and put more of their cash into things that matter, factories, training, etc. So relative to the rest of the world, we are doing better. And regardless of what you think of the efficiency of the tax cut, of deregulation, they are helping economic growth.
Okay.
Go to Europe, go to Japan, go to the emerging world, you get a very different feel. And the one word that we should realize is what's called divergence. You're seeing a lot more divergence in the performance of countries than you have in the past.
What does that mean?
So it means a few things. One, it means that tensions, political and geopolitical, are going to go up. Two, it puts pressure on the dollar. The dollar gets stronger. That means the risk of a trade war goes up. Three, it means that U.S. assets outperform the other. I'll give you a simple example. If you had invested in the S&P, a basket of 500 U.S. companies, you would have made this year alone 20 percentage points more than if you had invested in a basket of emerging markets. 20 percentage points more. That's a lot of money. And it shows you the extent to which the U.S. is doing better than in this case, the emerging world. But we have also outperformed Europe. We've also outperformed Japan.
So when you talk about the Trump trade wars, is this he's making a lot of noise and talking to a lot of people? Is this what do you see the future of trade happening?
I think everybody agrees there's been long-standing problems in the trading system. The treatment of intellectual property rights in China has been a problem. Mm-hmm. If you're a business and you want to open up in China, you're forced to do it through a joint venture. You're forced to bring in a local partner, and you don't even have majority say in what goes on. And that is very different from how China gets treated here. There's also trade agreements that were signed decades ago and don't reflect today's reality that need to be modernized. So everybody started with agreement that there are things to fix. The prior approach was do it collaboratively. Sit down with your trading partners and try to agree. And the notion is trade is cooperative. So when you and I decide to exchange one thing for the other, we do it cooperatively. So if you're going to fix something that's cooperative, do it in a cooperative fashion. Along comes President Trump, who says, you know what, this is not working. Okay, we've been trying to do this for a long time. This is not working. I am going to take a completely different approach. I'm going to start imposing, forget the carrot part, I'm just going to use a stick. And the sticks are tariffs. I'm going to charge countries more for selling domestically. Other countries are first shocked by this, and then secondly, they say, well, if you want to play this game, I'll put my own tariff. So you get where we are now, the tit for tat. The hope, and this is what the strategy is based on, and that's what people have to make a judgment. The hope is we get a repeat of the 1980s with President Reagan. At the time, President Reagan looked at the geopolitics and saw a superpower called the Soviet Union, what he called the evil empire, that was not playing the game properly. And he decided that despite the cost and risk, the right approach was to engage on a military buildup. And the cost is you had to pay for it, so the budget deficit got very large. The risks were that you may end up triggering the conflict that you're trying to avoid. But the bet was that the U.S. would win this war. It would win this battle. It would win this race. And in the event, the U.S. won big. Not only did the Soviet Union agree to denuclearize some of its weapons, but we basically changed the landscape of the Soviet Union. The Soviet Union ceased to exist. So President Trump is making the same bet on trade. He's looking for the Reagan moment. The U.S. will always win a relative trade war. It's bigger, it's more diverse, it's more entrepreneurial. And as long as you're willing to incur the cost and risks, you hope that others will see that and will give you concessions. And I think that that's what's going to ultimately happen.
So you're saying President Trump is saying that the U.S. is too big of a trading partner, that it's basically bringing them to their senses.
Yeah, bringing them to their senses and getting them to agree to things that he feels they should have agreed to before.
Yes.
And you've seen this happen. Mexico has agreed on NAFTA. Europe has de-escalated. The big standout until now is China, and that's where the critical issue is can you get China to realize that ultimately the U.S. is serious about this and that the U.S. is willing to incur the cost of a trade war. If China fully believes that, then it will make the concessions, not because it's the first best, but it's a lot better than the alternative.
So being a bond guy and risk averse, what's the if? But if what?
So the if is you get a mistake, okay? That the tit for tat gets out of control.
What does a trade war look like? Because we really haven't had one.
Yeah, no, we haven't. We had one. We last had one in the 30s, and it contributed to the global depression. Look, a trade war is very simple. It means that you and I, as consumers, go to the shop and find that everything we buy from abroad either is not available or is a lot more expensive. So we're worse off in terms of what we can get. Companies who make money out of selling to the rest of the world find out that just like we are now making foreign goods more expensive, other countries are making our goods more expensive. So they sell less and they employ less. It's called it was the scary word called stagflation. Stag means your prosperity stagnates because you're not making as much money from selling to other people, and you can't buy what you want to buy at reasonable prices. And deflation means that prices have gone up, so you hit on both your income side and your price side. That is the risk of a trade war.
Wow. So it's not good.
No, and that's why previous administrations were very hesitant to engage in a tariff tit for tat. Okay, but President Trump decided that the only way to get the attention of others is to remind them that the U.S. is more powerful. And as long as we're willing to take the risk of a global trade war, the risk of stagflation, this is a battle that we win, just at what cost you win it.
Yes.
Being that you're the king of bonds, you know, what everybody talks about, there's another war going on, is the Chinese own many, but trillions of U.S. treasuries, right?
Right.
What does that mean? Because I hear that, well, that's another threat, you know, so we have trade, and then we have the money wars, which is the bonds. And if China decided to sell their bonds, what would happen? You know what I mean?
So people who will paint very, very dark scenarios tell you it starts with a trade war. Then the Chinese decide that, well, if the U.S. is going to hurt us so much, we're going to hurt them. We have trillions of dollars of U.S. bonds, so we're just going to flood the market with those, and we're going to try and undermine the U.S. financial system. I don't believe there is any meaningful probability of that happening. Okay, if it's even 10%, I'd be surprised it's that high. First, because China would suffer even more in that world. Second,
why would they suffer?
Because China doesn't have the depth of economic resilience that we do. Okay, so they are still a developing country. They still have billions of people to get out of poverty. They don't have the shock absorbers, the institutions that we do. So they have to be careful not to take on way too much risk. But the second reason is much simpler. You cannot replace something with nothing. There's a reason why China owns so many bonds, which is that the U.S. is at the core of the global system. We supply the reserve currency, which means other people use our currency, and we have the deepest financial markets, which means other people own our bonds. Now, they do that partly because they want to, but really because they have to. There are no alternatives to what the U.S. provides. So it's one thing saying, I'm going to sell. Yeah, great. What are you going to do? What are you going to do with the money? Where are you going to go? And when you realize that you cannot replace something with nothing, you quickly realize that that's not really an option, that even if the Chinese political system viewed it as desirable, it's not feasible. It doesn't mean that we should not worry about it, just that we should assign the proper probabilities to it.
So there's three types of war. There's the bond war, there's the trade war, and then there's military war.
Right.
And technology wars. So
yeah, and what we've realized today is that in the old days we used to think of military wars as being fought physically. Now we've realized they can also be fought in virtual space, and that's a frightening, by the way, realization.
What does that mean?
It means that if I want to disrupt the U.S., okay, I don't have to attack the U.S. I can simply infiltrate, technologically wise, the power system and bring it down. I don't have to blow up a power plant. Okay, all I have to do is find a virus somehow that comes in to the computers at the power station and bring it to a standstill.
Okay.
That's why non-state actors, which means non-governments, are something we worry about a lot more, because it's you don't have to have an army anymore to disrupt a power plant. You can do it through a virus.
Well, this time has gone so quickly, so I'd like to just let you say what you want to say to our audience, whatever else is on your mind.
So the only thing I'd like to say is that, in the 10 years since the global financial crisis, we've come a long way. We avoided a major depression that would have hurt not just us, but our kids and our grandkids. And we have much stronger banks. So the good news is that we've come a long way. Having said that, there are a lot of things that didn't get fixed, and then there are all the side effects of the fact that we use an imperfect medicine, what we talk about in terms of the Fed. So don't be surprised that you feel uncertain. Don't be surprised that you feel unsettled, that you still aren't confident about your future. That's natural. And there's a lot you can do. And remember, you just need three concepts: resilience, the ability to navigate a shock; agility, the ability to respond quickly when you have better information as to how the world is evolving; and then optionality. Keep your options open. Don't close too many options. And those three principles are important to us as parents, how we think about our kids' education. They're important to us as investors. They're important to us about how we think about our workplace. So just keep them always front and center when you think about planning for your future.
Well, Mohammed, the time has gone very fast, but thanks for being a great teacher to the world through the Rich Dad Show. You educated me a lot because I'm a real estate guy. I don't understand bonds. Any comments, Kim?
I just thank you so much for your time, Mohammed. You kept it very simple, and we appreciate that and your wealth of knowledge. We just barely, I have so many questions, barely scratched the surface. We would love to have you back on the show again if you're open to that.
It would be my huge pleasure and honor. Thank you for having me on.
Oh, thank you, Mohammed.
Thank you very much. And we come back, we're going to have a favorite part of our program, Ask Robert.
You're listening to The Rich Dad Radio Show with Robert Kiyosaki.
Don't be like Charlie. Charlie is that do-it-yourselfer who does himself in. Do-it-yourself is good for tile and grout. It is not good for asset protection. Charlie thought he'd save a few dollars forming his LLC online. With no guidance, he did it wrong. When he sold the property, he lost thousands and thousands of dollars. He did himself in. by trying to do it himself. Don't burn yourself. Use Corporate Direct to set up and maintain your LLCs and corporations. Corporate Direct is owned and operated by attorney and rich dad advisor Garrett Sutton. Garrett wrote the bestsellers Loopholes of Real Estate and Start Your Own Corporation. He is Robert Kiyosaki's attorney for asset protection. He and his team will do it right. Visit them at corporatedirect.com or call 800-600-1760. Mention Rich Dad and receive $100 off your formation fee. That's corporatedirect.com. corporatedirect.com.
Log on to richdadradio.com while you listen. Now back to Robert Kiyosaki.
Welcome back. Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. And once again, thank Muhammad Al-Arian. He's a fantastic teacher, but in my world of money, he's one of the most respected gentlemen there is. And he is the chief economic advisor at Allianz and former CEO and chief investment officer at PIMCO. And the reason it's important to understand his view of the world, if you want to see the future, is the bond market is the biggest market in the world. Everybody watches the stock market. Apple's going this way, Amazon's going that way. But the bond market is the biggest market in the world. And that's where the rich guys put their money. If you understand that one. And I was talking to our friend Kenny McElroy, and we were saying, we really don't know much about bonds. And if it's the biggest, all the rich guys put their money in bonds. And for a country to be rich, it must have a deep bond market. Poor countries don't have bond markets. In other words, they got no money. So anyway, that's why having Muhammad on it is just fantastic. Trust you guys learned something from him. Please listen to it again and discuss, because that's when you learn even more. Any comments, Kim?
Well, a couple things. I found it really fascinating when Muhammad was talking about, when interest rates go down, if you're holding a bond at 5% and the interest rates go down to 3%, all of a sudden your bond is very valuable, but future bond market is not as rosy, which is just the opposite if you're in real estate. So if the interest rates go down for real estate, the future of real estate looks really great. So it all depends on what side of the coin you're on when things change. So interest rates go up, that's good for some. Interest rates go down, better for others. So it all depends on which side of the coin you're on. Yes,
so again, thank Muhammad. He's a real teacher.
I also loved what he said about the three things that you need as this whole instability is happening. Number one, you need resilience, how quickly you come back from a setback. You need agility, how quickly you can respond and move. And you need optionality. You got to keep your options open.
Right. So anyway, I want to thank Muhammad Al-Arian again. He's the book, The Only Game in Town, Central Banks' Instability and Avoiding the Next Collapse. Remember, there's booms and busts, there's crashes, and there's collapse. And a lot of our guests have been using that word collapse. It's a very important word. And I love that he talked about the trade wars and cyber wars and money wars. We're at war right now, and that's why it's the instability out there. So anyway, thanks again to Muhammad Al-Arian. Once again, you can submit your questions to Ask Robert at richdadradio.com. What's the first question, Melissa?
Our first question comes from Sasha in New York. Favorite book, Rich Dad, Poor Dad. With today's shifts and uncertainty in the market, how do you and Kim prepare for the coming shift or collapse? Are you still investing in the markets and real estate in the current climate?
That's a very good question. First of all, markets go up and markets come down. But the one thing Kim and I have invested in since we've met, what is that, Kim?
Gold and silver.
And that's why I have a new book coming out. It's called Fake. It's about fake money, fake teachers, and fake assets. To me, anything that's man-made, or women-made too, stocks, bonds, mutual funds, and all that stuff, it's unstable. So to me, the dollar, the U.S. dollar says, in God we trust. No, I don't trust in God. I trust in gold. And so when the U.S. government, back in 1971, started to print all the money they wanted, that put the whole, the metrics of the world off balance. So that's why in the book Fake, and I understood what was happening in 1972. The book Fake starts with me being in Vietnam and going to look for real gold, flying off an aircraft carrier in Vietnam. And I became a gold bug because I realized gold was real and the dollar was fake. So that's why when I met Kim, we've been buying gold and silver for years, right?
We have. And actually that goes to one of Mohammed's three keys was agility. So if the whole financial markets collapse and the banks collapse, we've got gold and silver to use as real money.
Because it's real. And that's part of the big tenet of Rich Dad. So we use real estate because not that real estate is real, but the titles are real. I mean, we actually own something, I would hate to be in a country where they can take your land. And right now, that's what's happening in South Africa. Is it called EWC, expropriation without compensation? That means the government can just go in there and take your land. That's not a safe place to own real estate. Are they going to do it? I don't know, but they've done it. They've done it in Zimbabwe and things like this. So that's what Muhammad was talking about. He's got to be agile and all this. And I just came from my friend. I love South Africa, but because they don't really trust their government or the people, the socialists and the communists who want to take from the rich and give to the poor, if they take the land from South Africans, that title means nothing. So it's not the real estate, it's the title. And the great thing about many Western countries is titles are very, very solid, same as gold and silver. You can submit your questions to Ask Robert at Rich Dad Radio, and thank you for listening.
This podcast is a part of the C-Suite Radio Network. For more top business podcasts, visit c-suiteradio.com.